Welcome to the Risk Reversal Podcast. I'm Dan Nathan. I am joined by Gene Munster. He is the managing partner at Deepwater Asset Management. Gene, welcome back to the pod.
Always great to be here.
All right, this is dropping Wednesday morning. That would be May 28th. And this is a big day. I mean, we've been talking about this quarter after quarter after quarter. It feels like for 2.5 years or so. This is Nvidia's earnings. Usually they come, close to a month after we've heard from most of their major customers. You know who they are: Microsoft, Apple, Google, Amazon, OpenAI, we don't get to hear from, but those are also a big one. So that result out tonight after the close. So we're going to preview that. We're going to talk a little bit about that ecosystem. I want to talk a little bit about OpenAI. It looks like they just made the most expensive acquihire in the history of acquihires, or maybe of all M&A, right? And I also want to get your take from Google I/O. I know you've been talking about it a little bit on the socials, and you were on Fast Money last week to talk about it. I just want to see if there's any kind of shifting thoughts. I know that you were a lot more constructive than most people out there into that event, so I want to hear your take on the way out. Okay, Gene, Nvidia. Tomorrow after the close, 8% implied move in either direction. The stock has made up a lot of ground. I think it was an all-time high, at least, intraday high, I want to say in late December, $153. Here we are at $135. It traded below $90 in the early April period. So we've come a long way. How are you thinking about the name? Let's put price out of the equation here. Like I said, we've heard from some of their major customers. We saw how the market perceived those CapEx numbers, and they seemed okay with it. So how are you thinking about things into the print?
We own it. I think the best way to understand an investor's thesis on a company is just to look at their portfolio. And so we do continue to own this. My confidence in the AI hardware piece has strengthened since DeepSeek came out, and even more strengthened since we've heard from the CapEx from the hyperscalers a month ago. And even the past couple of weeks, continue to hear positive feedback. And so the way I think about it, there's two orbits. One is what's going on with the broader spending around AI and how this tech is advancing. And the second orbit is where they're going to be spending their money. And on the where they're going to be spending the money, I still believe that Nvidia has an advantage when it comes to cost of ownership, despite their $30,000, $40,000, $50,000 for a GPU. I still think it's relatively cost effective. And so, I mean, at the most basic level, I think that growth in calendar 26, because there's going to be a lot of noise over the next 3 quarters when it comes to growth rates we can talk more about. But I think that the growth in calendar 26 is going to be measurably above where the street's at. And I think the street's at just under 25% growth right now. So feel great going into the quarter. I'm not suggesting that it's going to trade up or down on Thursday, but I think that a month, 2 months, 6 months from now, the stock's going to be higher.
Yeah, let's take a step back here, because I think that's really important. Who you are in the market. You take very long-term, thesis about themes, and then also, the sort of names that kind of fit within them. And, on the day-to-day basis, I know you come on Fast Money. I know you do your own podcast. You've been very gracious coming on our podcast, I want to say a couple of times a month or so. And I think that's just a really important distinction. Oftentimes, Guy and myself, when we're on Fast Money, we're asked what happened today, what might happen tomorrow, what happens in the print. And I suspect you don't give a shit if it goes down 8%. You know what I mean? Especially if it's one of those situations where maybe you can't put your finger on something that's truly fundamental that would cause that and turning it into something else. And then the flip side of that is from the highs in January to its lows in early April, the stock sold off intraday high to intraday low over that period, nearly 40%. Now that's something, if you own it for the long term, is the sort of thing that could make your stomach churn a little bit. It tests your mettle, if you will. So, that's one of the things I think it's really important to differentiate. But how do you know, and this is more of a stylistic thing, okay? We'll get back to the fundamentals and everything like that. At what point in a broad market sell-off where the sentiment shifted, but you haven't seen much diverging as far as the fundamentals are concerned, other than what investors are perceiving, when do you start to think twice about your thesis in the throes of a sell-off like that? And you can make the same argument, because we saw it in Nvidia for 2 years, in 23 and 24. At what point do things look way overdone? I'm just curious how you think about that sort of stuff.
Well, the central question we ask is, what's the growth rate going to be in the out year? And so any sort of data points that we can pull together that give us confidence about that. And the market is screaming at you when the stock's down 10, 20, 30, 40%, that you're getting that wrong. And just because it's rallied doesn't mean that we've got it right about what next year is going to look like either. But at the core, we really try to ignore the noise of the market. And I think one of the pieces that's been encouraging over the past, let's kind of take it past spring of 2020, is that the pace of these rips back and the market has been faster than it has been over the last 15 years. And typically, if we go back, like let's go to the dot-com period, it would typically take, when you'd have these downdrafts in these stocks, it would typically take 53 trading days to get the stock back to where it was before the 15% correction. And now we're just seeing them kind of come back faster. So in other words, is that since we've been rewarded for waiting faster than what we had thought, that gives us a little bit more like psychological confidence to just kind of weather the storm, because we know that things can quickly change. But it all comes down to like, what are we actually hearing and seeing in terms of like hardcore data points? So we can go through some of those that maybe aren't as well-traveled data points, but that's what we're focused on.
Yeah, and that's a really important point about the speed in which we're seeing these sort of V reversals. It's actually not giving you enough time to really test that long-term thesis, because it's going down so quickly and bouncing back so fast. Sometimes those dislocations offer an opportunity. Before we get to some of those data points, let's just talk about some of that out-year growth that you're expecting. And let's be clear, this is fiscal Q1 for 2026. They're going to report tomorrow night. And so, expectations for this year are 46% EPS growth. Next year, a step down to about 30%, if I have that correctly. And then from a revenue perspective, and you've been correct on this is inched higher over the last few quarters as we've talked about it. So for current fiscal 2026, we're expecting, or consensus is expecting about 54% revenue growth. And then that decelerates to about 25% next year. You have been in the camp that you think the fiscal 2027, both earnings and revenue consensus is a little bit too low. And so we're trading about 31 times this year and about 24 times next, and that's on earnings. So thoughts there on how you think about that, because is this quarter going to be one of them that you think the street starts moving higher in their expectations for the current year and then possibly for 2027?
I don't think the street moves higher on this quarter. I do want to just put a finer point on this. What's happened with estimates is that if we rewind to DeepSeek, right when DeepSeek happened, the day before, expectations were for about 20% growth. And then they kind of quickly dropped to about 18% growth, and now we're back to 25, just to give you some context in terms of what's happened over the past few months. As far as what happens to the numbers, it's a pretty unique setup with the outlook, at least the commentary for July. And part of it is because of Jensen's comments recently, a few weeks ago, where he talked about this hit for the H20 being banned. And he said that this is going to cost him $15 billion in sales. And so that starts in April is when those harder curbs got put into place. And so there's a disconnect between what the whisper numbers are for the July quarter, which is around 38, 39 billion in revenue, and what the in-print numbers are, which is almost 46 billion, 45.8 billion in revenue. And so if we take the case that over the next 3 quarters, they need to lose 15 billion of H20, assuming there's no changes to the curbs. But there's also going to be some upside in their other business, because the fundamentals on this, we can talk about those data points, but is more positive. You're probably going to net out to something like a $10 billion downward revision. And that would essentially take calendar 25 revenue growth from, it's currently, as you said, about 54%, to, if you adjust that 10 billion out, to the mid 40s. So for a stock, I mean, that should be like flashing red lights for a stock that is been on a tear for the last 2 years. And we're talking about some material downward revenue revisions. And that's kind of why I started with, I don't know what the stock's going to do, because my sense is investors know that this is coming, but maybe they're hoping that the upside from the other business, from non-China, over offsets it or something. So hard to figure out how it's going to react. But essentially, all that pain, if in fact they do lose out revenue this year, all that is going to create an easier comp for next year. And so you get to an easier place. The absolute number may be the same for calendar 26 as is today, but the actual growth rates will be probably more like 30%.
Yeah, so what's interesting about this setup is they talked about that $5.5 billion charge, right? And that's how you got to the $10 billion. And
Let me interrupt there real quick.
Yeah.
There's some confusion, present company included, because he talks about a charge, Jensen, and then he also talks about this lost revenue going forward.
15 billion. That's where I was going. And so, the guy has been speaking anywhere there's been an open mic over the last couple of weeks. So if folks don't actually have a good sense for those sorts of numbers when they kind of guide, I'd be super shocked because, again, at the end of the day, it's really the institutional community are the ones who are going to be driving the train on this. And yeah, I'm sure there's like plenty of retail participation. But one of the things that's been really interesting over these last couple of months is like story after story, article after article about how retail was unfazed by this period over the last couple of months. If you're talking about inflows, if you're talking about interest in ETFs, that sort of thing. And so it's funny to me that it doesn't seem like there was too much of retail trepidation about a name that they've loved, for the last couple of years, and they seem to be holding on. And so I think that's really interesting. And so I guess the next question I have is that, as much as Jensen's been talking, what has he left for the conversation on the earnings call? Because, it seems like there's been so much ink spilled over the last month or so. He's kind of like, put it all out there. So I'm just curious, as you think about from a commentary standpoint, any expectations there?
On the negative side, he's got a lot of air cover going into this, any sort of commentary, any sort of blemish, any sort of challenges with the business, he can easily kind of comb that over with a commentary about the curbs. And so what's potentially left open is actually a window for surprise where you have the commentary being, yes, we lost out on this because of these curbs, but the good news is everything else is going better than what we thought. And if we kind of normalize that out, we're seeing acceleration in growth. That like level of detail hasn't been framed in. And so that's probably the one upside. Like, would he say, I don't think he would say, if in fact the opposite is happening, that the curbs are impacting and they're seeing some other form of fractional slowdown, I don't think he would say that. I'd be shocked if that happened. So I think that like from a commentary perspective, that's probably what's on the table is most likely don't expect anything outside of what has been framed in here. But the upside surprise would be that piece about let's zero in on the non-China business. That piece is going really well.
So there's two things here that I think are really important as it relates to this trade war, right? So if you think about, like, it was always my view, and you and I have been talking about this probably for the last year or so, that Apple and Tesla were like right in the eye of the storm, right, of any China, U.S. sort of like protracted sort of trade war, and that those are two big bargaining chips. Well, Elon might have helped himself a great deal, as it think about the proximity to Trump and in the negotiations and the like. But Apple, on the other hand, and both of these CEOs, they apparently had been playing this new administration, pretty well here for all intents and purposes. Both of them were up on the dais at inauguration. Let's take Elon out of it and his other participation and obviously all the stuff in the campaign and then afterwards with Doge and the like. But Tim Cook, this is somebody who has navigated both President Xi and President Trump pretty well so far until a tweet last week, right? We thought by two things, right? Supporting the president, then announcing, $500 billion of investments over the next 4 years here in America, reshoring some of their manufacturing for iPhone to India. You thought this would all be enough, right? At least in the near term. And then last Thursday, I think it was, Trump puts out a tweet saying that, 25% tariff on iPhones if they don't move that Indian production here to the US. Now, you and I know that would take really years to do for all intents and purposes, right? So where does Apple kind of fall out in this situation? Because Trump, for some reason, he doesn't do, like, if Tim Cook was down at Mar-a-Lago last weekend and he's saying all these pleasantries about him, he's not tweeting about it the next day. Do you know what I mean? Something in the background apparently is going on. Is that fair to say? Or, I know you don't know and I don't know, but that came out of nowhere.
I want to dive into Apple in a second, but just before we leave NVIDIA, I just want to make one comment. I was mentioning these other data points just quickly about like where my confidence comes from. And Elon's comments last week about 1 million GPUs, and the majority of those are going to be NVIDIA. That could be 30 to 40 billion in revenue. Now, everyone's aware of this. Like this is not some inside comment that's being made, publicly made. But to put that into perspective, I mean, that could add, if that's over a 2-year period, that could add 15% growth to just that deal alone. So I want to leave there with some confidence that the fundamentals of NVIDIA are in great shape. Changing gears to Apple is somebody who's watched and invested in this company for a long time. This has been remarkable, the shifting gears. And it was pretty jarring for me on Friday morning seeing this, because I know how much Tim has invested into the relationship with Cook. And I had an opportunity on Friday afternoon to have discussions with some of the former high-level U.S. trade officials that are still orbiting the conversation, I think still have a voice in everything that's going on there. And there were two things that really stuck out to me. That kind of the focus of the conversation is what's going on with Trump and Apple. A couple of things stood out. First is that Trump does have this belief that the U.S. should essentially kind of go at it alone and therefore don't really rely on allies. And if you take that approach, therefore, you need to worry about how you can keep things going on your own merits. And of course, we don't manufacture technology for the most part in the US. And the example that one of these former trade officials gave was, imagine in the mid 70s being that the kind of the core of US hardcore manufacturing was automotive. At the time, imagine all that was 100% of that manufacturing was done out of Moscow. Like, there's no way when the US, Soviet Union during the Cold War, there's no way that that would happen. And therefore, Trump wants to bring some of this manufacturing back. And he can't do it by himself. But one thing he can do is pull tariffs out, and that's his lever. And so he's basically using Apple as an example to say, he's speaking to Cook. He's also speaking to the broader tech leadership, Jensen and Microsoft, and to bring more into the US. So that was something that was informative for me. But the piece that surprised me is, despite all that, what apparently is more important is keeping the economy together. Because even though it would be all good for, if you do want an isolation type of an approach to running your country, it would be good to bring this manufacturing of devices back. The reality is that you're not going to get reelected. The party will lose if the economy is in a bad place. And so what I left was with a sense that that's going to be the moderating factor here, is this conversation about what's going on with Apple and the direct tariffs. I think that the administration is really trying to figure out how they're testing different, negotiating was the word that they use, with business leaders and the public about what they can get away with in terms of the size of the tariffs. But ultimately, they're not going to do anything that's really going to break the economy, because that would be pretty bad. And so, like, that was like a whole different lens I left with, of like, it's more than just a headline of an Apple 25% tariff. One other piece that came out too was that on the tariff side, it's off of the cost when it comes into port. And so it's not really a 25% tariff. It's more like, based on my math, like a 14%. And Samsung would be tariffed equally as well. So, I mean, there was a lot I just gave you there. But I think that the core takeaway is that the economy is what matters most. And that's probably what tech investors should be most focused on. Don't worry about the headlines. Look what's going on with the economy.
So your point about, like, on the economy, right? Like, I think that's really important. They don't want to break anything, but when I think of just kind of the back and forth, it's one of those things that even if you are one of these supporters of the president, or at least optically, right? And you've made these commitments to this, that, whatever, and you're talking about investing here in America and reshoring some sort of stuff. It's just like, sooner or later, being a bit of a punching bag is getting a bit annoying here. And, so I just think the boy who cried wolf, I mean, we've seen this now like 4 times. You kind of put these reciprocal tariffs on China and then you dial them back, and they don't have to say much to get that to happen. This morning we see it with the EU. I mean, we saw it with the UK. I mean, we're getting a lot of upward gaps on this. And Guy and I have been going back and forth on this. It's like, okay, if the algos are picking up the headline and they're taking things higher, you can't just blame it on the machines, because there's folks who are making qualitative investment decisions to keep it going. So a lot of folks are saying these threats don't have a lot of teeth anymore, which actually weakens our bargaining. I think there's a good chance that we get into, 2027 and we have made no real progress, from where we were at the end of last year. Is it, thoughts on that is from a trade perspective and how we're being perceived around the world?
So I was mentioning this call with these former trade officials, and one of them had this analogy that spoke to that. And essentially, it was a story about a father who had a son, and whenever he would basically make a mistake or do something where he had to be punished, he had to drive a nail into a workbench. And then each time he did something good, he got to remove the nail from it. And at the end, what the father showed the son was that despite the fact that those nails had been removed, there was still unrepairable damage to the workbench. That wood had been damaged, and that scar tissue essentially was still there. And this topic around, what's the adjective you want to use, erratic behavior or kind of unpredictable behavior around these tariffs can have some lasting impact. And I think at the end of the day is that's not going to change. That's the style. And even if that does have some damage, I think that some of the advising that the president's getting is that be aware of this damage. I don't think that really resonates. And I think from as we kind of fast forward 2, 4, 10 years from now, leadership changes, and maybe that would be the kind of point where there's some, if you're in the camp that feels that the U.S. has lost some credibility, then that's kind of when that gets rebuilt. But I would not expect any change with the current cadence. Essentially, he gets some wins, political wins. He's had them over the past few weeks, and then he pushes the boundaries. That's what he did with Apple on Friday. And then he's testing. He's putting these balloons out. There's damage with that, but there's also him moving forward to try to get to this optimal tariff.
And that's a great analogy, the scar tissue, the damage to the wood and everything like that. And I totally get that. I guess my only point is that, the idea that this is going to make an impactful change, to global trade in the near term is not particularly great. And especially a lot of the stuff that you're possibly, kind of looking for, the manufacturing reshoring, it's going to take a while, right? And so I just say to myself, if you come back to they don't want to mess with the economy, well, they're messing with the economy. They're messing with the global economy.
Hasn't happened yet. I mean, the market, and this is one of the other pieces, is the president looks at the market. And when he makes these adjustments and see the market coming back, I think he's feeling more empowered to push the envelope.
Yeah, and that might be, the sort of thing where all of our political adversaries, overseas, and our allies for that matter, they know that. I mean, so this is a play out of the playbook. Like, they know that. And don't think for a second that they were not unhappy in April when our stock market was careening lower, far worse than all the other countries. And so there's no reason to believe, it's been my belief, when you start messing with things like the economy, first and foremost, right? And there is a lag, right? You can look at the markets and say that is a kind of a lens into what might be happening in the economy. I think this time around, if you just look where we are, we're unchanged on the S&P, we're unchanged on the NASDAQ. At the highs, we were only up 4 or 5% or so. You could say no harm, no foul. But under the surface, if companies here are slowing up CapEx and R&D and just the uncertainty that they may face from businesses if they're their customers or consumers, that sort of thing, that's going to be a lagging indicator. That's going to take a little while. And so I just don't think we're going to have any material sort of agreements on trade. And if we do anytime soon, it's not going to be the sort of thing that I think is a huge benefit, to our economy. And make no mistake about it, if we do have, higher tariffs, even if it's 4%, 10%, whatever the hell it is, it will weigh on the economy. I'm not rooting for that. My only point is none of this really needed to happen this way. You know what I mean? So, and it's here nor there. I just think the longer it goes on, this second time around, I think the less teeth that it has. And I think it might end up hurting us more than some of our, trading partners in the near term, for whatever that's worth.
My general thoughts are the market wants visibility. The market's okay with, I think the market would be okay with lower GDP growth with a 10% tariff. I think that they just want to know it's at 10, not 30. And so I'm kind of more focused on that piece. I also think we're going to get resolution in the next couple months. I think it's sooner than, in part because I'm buying into this view that there needs to be resolution to keep the economy in a good place. Starting this fall is kind of when the cycle starts around the next, the midterm elections. And so a year out, you got to get the economy kind of moving in the right direction right now to prevent hitting an air pocket in fall of 26. And so I think bottom line is I don't want to weigh in bad policy, good policy. I think the market just wants visibility.
Yeah, no doubt about that. All right, let's talk about OpenAI. I mentioned this acquisition of Jony Ive's design company, $6.5 billion, all stock. Obviously, OpenAI is a private company. My first response is that, this is a pretty expensive acquihire. It takes me back to, I think, 2014 when Apple bought Beats. It was Jony Ive and Dr. Dre, and they
was it a 1.5 billion or 3 billion? I forgot.
$3.2 billion. And it was Beats streaming service, and it was the kind of earphones and all that sort of stuff. It was a total zero. And it was so uncharacteristic of Apple. But I do remember that there was this really cheesy video with like Tim Cook and Eddie Q and Dr. Dre and Jony Ive. You remember, and all these grandiose sorts of things they were going to do together, artistically, but also from a hardware standpoint. And then it brings me to this event here. So Jony Ive was obviously, very important to Apple back then. And now, he left in 2019. He really hasn't made anything meaningful from a design standpoint, but he was very important, whether it be iPod, iPhone, Macs, and Apple Watch was his last really big hit. And so you look at this video that Sam Altman, the CEO of OpenAI, put out with Jony. It was the cheesiest 9-minute video I've ever seen, where there was actually no detail about what these two guys are hoped to do together. They definitely talk about, and I saw Ben Thompson on Stratechery had a really interesting thought, is that Jony Ive, being reflective now, is probably like unhappy with his contribution to what's gone on with smartphones, you know what I mean, and their impact on humanity. Sam Altman seems to be in that same mode, except he's building a technology that could be far more devastating if you think about it. It could also be far more enlightening in many ways. And so what do you make of that? I mean, to me, my first sense is like, man, there's a lot of money sloshing around if somebody can drop $6.5 billion on something like that.
This is from my world. It's not your question, but from my world, this is like as fun as it gets. Bringing all these new parts to the equation. And I think one piece that is undeniable is that money getting sloshed around is that if there's a question about like, how far are we in AI and what's the appetite for companies to continue to invest? I think this is an example. Now, granted, it was equity. He got equity. So they didn't write him a check for $6 billion. He got $6 billion in equity in OpenAI. But I think that the bigger picture of this, there's just a lot of.
But it was dilutive. I mean, so the thought of that, like this is a dilutive, you know what I mean, like acquisition, all stock, and like some of the thoughts was that okay, maybe they were trying to dilute like this one portion of the business that is not meant to be the business portion, the nonprofit aspect or whatever. So maybe there's some goofiness going on. But I get it. You're saying this is fun to see these sorts of combinations.
But it's to your point, like just. Don't even worry about the details of what the product's going to be. Just look at the big picture, is that there are forces in play here that do give credibility to this view that we're still early in AI. And so maybe starting there, as far as kind of what does it mean and what did we learn? And they also put out a letter, Altman and Jony Ive put a letter out where they talked about it. And we can learn more on that. And, it's going to be this device that doesn't have a screen. As you said, I think Jony Ive has some remorse about what's happened with people and their screen addiction. And so going to try to fill in, they refer to it as a kind of a side device, a companion device. And so they actually talked about iPhone and Mac by name to sit alongside that, but said that down the road, it can evolve into its own category. And so one of the pieces that we come back to is they're going to show it next year. They said, we'll learn more next year. They didn't say it'd be available. They said we'd learn more, which probably means it becomes available in calendar 27. And he said his expectations are that this is going to be the fastest growing product to 100 million units. So iPod, 4 years to 100 million, iPhone, 3 years, iPad, 2.5 years, because it kind of built on the iPhone. So that's kind of the benchmark. So we're looking at, if Sam Altman has anything, this is really a 2028. So I think the big negative is just how do Apple investors kind of think about this? One other impact longer term. I think one of the other pieces is I've read more about it and kind of taken it all in is Sam Altman wants to be Steve Jobs. And I think that he views this as his opportunity to take on that role.
Yeah, I mean, I just look at it in a different, slightly more cynical way. It's like, okay, he's your childhood hero. My childhood hero was Han Solo, and I don't shoot first. You know what I mean? That sort of thing. It seems a little cheesy. And let's be honest. Jony Ive, his last hit was The Watch, which was 10 years ago. And make no mistake about it, that was being conceived likely before Steve Jobs died. Steve Jobs in the Isaacson book said that, for all intents and purposes, and I think Jony Ive, the fact that he's using this, he's like, well, Steve Jobs once said I was his spiritual, I don't know, whatever the hell, something like that, almost his muse in a way. It just feels like we're pushing on a string here, and the likelihood of this kind of being that important to ultimately displace the iPhone or some of the other wearables that are on 100 million arms, or you know what I mean, that sort of thing, is not particularly great, and it's certainly not going to happen on its first iteration, in my opinion. Because if this thing is going to be successful, it's not going to be cheap, and it's going to have to bump out the watch or something else that lives in. Does that make some sense to you?
I would agree that it's Jony Ive. He's brought his team with him, which is a world-class team, but that doesn't mean that this is going to somehow be a success. And I went through that time frame just to frame in, like, we're talking about 2028 as being the ramp year here. And so what we still have, there's a lot of time between now and then. And I think it really speaks to, these transformative tech. It took iPhone 2007, it came out. It really didn't start cooking until 2012. And so I think that it's just a good reminder in all this.
Two more things. I want to hit Google really quickly. I/O was last week. First of all, the 2 days after, the stock rallied 10%. Now, it came back a little on Friday. And so that was one of these sorts of, kind of underappreciated sort of stories. Sentiment got really all on one side, that sort of thing. And they didn't, initially, I think you were on Fast Money that night. There was nothing that was said immediately. The stock was up a few percent, then it went down. And there was a lot of chatter about what they were going to do and some of the products. And, it wasn't that meaningful, was it? I know that you listened to most of what went on here, and I'm just curious where your head is at right here, because I know you've had a lot of things to say about overviews over the last couple of months.
Quick recap: is positive on Google for a long time. A few months ago, we sold the stock because we felt like search is going to go through this transformation. And when you make a big move like that, psychologically, as an investor, you want to always stay on your toes and say, like, that was the move we made. That doesn't mean that we have to continue on this. And so when I went into Google I/O, I kept telling myself, like, be open to whatever they're going to show around search. And they spent about a quarter of the 2 hours talking about search. Whatever they're going to show, just give them the benefit of the doubt. And what they showed was AI mode, which is effectively a recreation of AI overviews, which is what they announced last year. And so I think that it's a small change, even though they talked about this being this big radical change. There's still sponsored links. It still is kind of a multi-experience search result. And I think that's still one of the fundamental challenges. They did at the very first, so they kind of kicked it off. I forget the woman's name who started out the conversation around search. And she used the word that search has gone through a profound change over the last year. And I think that is, like, if at the core of, like, this question about what's going on at Google, they're acknowledging that there's a big change going on. They're also acknowledging that there's a big change going on because their answer a year ago was AI overviews, and now they're coming out with a whole new answer, AI mode. I think that's good that they're innovating fast. I was encouraged by that, but I still, at the end of the day, even going into it with an open mind. Now, I haven't used it. I've been trying to use it. I still don't see it on my browser. My ability to use it, but my sense is that it still isn't going to answer the question, which what people really want is just a simple answer. And so I think that this question about what happens with Google and search longer term is still unanswered.
Yeah, and so for that main purpose, like, the stock should continue to underperform unless you see some sort of reacceleration.
I think it has bumps. We went back and looked at Blockbuster when it was on its way down. It used to be a public company, and they would have these quarters where the stock would go up 50% on a quarter.
Yeah, it was the mid 2000s. And yeah, no, that's a great analogy. And obviously a lot of folks like to apply that to a lot of dying TiVo. You could probably say some of the same stuff for both of those are on the island of misfit old tech toys, if you will. Last thing, Tesla, I follow this guy, Troy Teslike. I subscribe
awesome.
to his blog. And this is as it relates to obviously Tesla. And, he has been more accurate than most of the sell side analysts on Wall Street as far as deliveries and the work that he does. And, one thing really stuck out to me is talking about the yearly decline. So this year is going to be the third consecutive decline in Tesla deliveries. And so he made a point that if it comes in less than 1.6 million deliveries, that's down from 1.8 nearly last year. I think it was 1.765 or something like that. And so you say to yourself, 11.5% decline. That's his numbers. He says the situation is actually more concerning because Tesla has been sacrificing margin to boost sales by cutting prices, discounting new inventory cars, offering 0% financing, and preparing to launch a stripped down Model Y. And so that's all known, okay? But when I look at the news this morning that BYD, their major competitor in China, which just overtook them in deliveries in China, they're also shipping their cars in their fully electric or hybrid. Tesla does not have a hybrid vehicle. They overtook them in deliveries in China. And so I think about this story and I say to myself, okay, if BYD, and the headline this morning is that they are going to be cutting the price on 22 models in China by up to 34%. This trade war, or this price war, is not abating anytime soon. And this has been something that's been weighing on Tesla now for 3 years. And so there's no evidence that there's any price elasticity in this market, right? And so I don't know. I've been in the camp that at least the auto portion, the best days are over. Like their auto gross margins are less than that of GM and Ford. And I don't know how this stripped down Model Y is going to help them other than keep market share.
I want to apologize to your listeners because often when we have this conversation, I'll say something like, I love this debate. They probably get tired of hearing that, but I do love this debate. And I love having the debate about specifically, does the car business matter to them? And I think it does matter. And I think, by the way, I would agree that Troy's data is awesome data. Agree that the street's still too high this year, that this is going to be a messy year. There is one little nuance there, is that it was a tough March quarter, but their automotive gross margins were a little bit better than what people thought. So now that's not a 30% price battle with BYD. That's very different. That can change all the dynamics around it. I think what the stock has told us is they largely don't care about the automotive business. It's razor and razor blade. And this dynamic around the whole, we're an AI first company and it's about autonomy ultimately. And I think that is the kind of one of the pieces that comes together. And when I think about Tesla, one of the reasons why I'm optimistic, and as I look at what's happened with Apple and what's happened with Google, I think it comes from having peacetime CEOs. Both Sundar and Cook are just that. They do a great job. Wartime CEO Zuckerberg was peace, now he's war. I think Bezos has been both. But Elon only operates in a war mentality. And if anything is at status quo in a piece, he'll blow it up. And so I actually think that, I'm a big believer in physical AI, and I think you probably need a wartime CEO to go up against BYD. And so with all of his flaws, I still think he's the right person and the right concept of focusing on autonomy. And I'm not trying to dismiss or say, don't look at all these blemishes, what's going on the automotive side. I do think, by the way, that's a great business longer term. I do think all cars should be electric. It's not a political statement. I just think that it's a better way to move around. And so I'm still in the camp that this year they can pretty much do whatever they want to on the fundamentals on the EV business. And as long as they show progress in autonomy, I think investors are going to continue to reward the stock.
Yeah, the only problem with autonomy here is that if you're talking about full self-driving, like let's forget like robocab and taxi and autonomous fleets right there, because that's years away. BYD is giving away their full self-driving for free. You know what I mean? And that was going to be the thing that added the margin to this story. So I'm not sure the prices of these lower end cars ever go back up. And I think BYD is willing to kind of cede margin, right, to take market share.
Right. And that's By the way, yeah, that's what Tesla's going to want to do too, is get the vehicles out there.
Yeah, but they have been getting the vehicles out there, and they're only going lower, and people don't want them anymore in a lot of different locales. And I'm not sure how you fix that brand damage. But again, you and I can have this debate again and again, and I like it too. Gene, you've been amazingly generous with your time as always. I hope you'll come back really soon. I appreciate the conversation.
For sure. Can't wait.